India has voted Narendra Modi and his National Democratic Alliance back to power with a resounding mandate. The ruling coalition not only extended its lead over the opposition, the Bharatiya Janata Party by itself has won an absolute majority in the Lok Sabha. How will this impact policy, business and in turn markets over the next 5 years? To discuss all of that, we are joined by a very special guest, S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential Mutual Fund. Naren, good morning. Thanks so much for taking the time out. What's your sense, Naren, of what does this mandate mean for the markets, for the economy and for the business community?
Actually, I've been working for 30 years. It's only in the last 5 years that we have seen a single party having majority. When you have a single party having majority, it is very, very good that you're able to control the economic policies in a much better way. So if you look at the way BJP has handled the last 5 years, there are 3 key indicators to determine economic stability. One would be fiscal deficit, second would be current account deficit, and third would be inflation. And on all these 3 parameters, we have had a very, very steady, good performance over the last 5 years. Clearly, the 4th parameter is where I believe that the next 5 years will be much more important, which is the growth parameter. And I believe that the steps taken by BJP like GST, RERA, IBC, all these things would help in the next 5 years. And it's very important that along with the focus on economic indicators, we are able to create a supply side revolution where growth picks up in the economy in every area, and that is what we are looking for. I think it's a great development to have a single party which is committed to financialization of the economy and formalization of the economy in power for the next 5 years, because it is going to lead to good benefits. I think the entire international investing community is also very, very pleased with the results, and the market reaction yesterday should not be construed as their market reaction. Actually, whatever conversations we have had, we believe that the international investing community is very happy with the developments of yesterday, and we will see that entire thing playing out over the next 5 years rather than what has happened yesterday.
Point well taken. Then, do you reckon that the markets will bake in a slew of new reforms which could be very critical to do in the near term itself for, say, for example, on the liquidity front or streamlining GST, etc.? And will that all start getting priced in? Because right now, ahead of the event, when we had this move up, we priced in pretty exorbitant earnings growth as well as political premium in the valuations itself. The correction notwithstanding, we are not cheap as yet.
So I think the valuations is the single biggest problem to the equity market. And in my opinion, there isn't any scope for any cutting edge big reform to happen in the near term. What is the main problem in the economy is the fact that land, labor and capital are the 3 factors of production. Other than labor, both land and capital have not been low. And I believe what happened was in the last 5 years, primarily the NBFC and the housing finance industry kept land prices up by lending to the real estate developers in many parts of India, keeping land prices up. So I think if and more than reform, if the problems of very high land prices and higher interest rates can be resolved through deleveraging in the next 6 months to 1 year, I think that would stage for a very, very good bull run for India. Because once the 3 factors of production, land, labor and capital, come down, I think India has a potential of nascent demand which can actually pull growth over the next 4 years. The challenge is how do you bring down land and capital price down so that you can create this boom is the biggest challenge that the government has, because it is not easy, because there is a fair amount of leverage against everything to do with real estate at this point of time from the NBFC, HFC industry. and how the government can bring down real estate land prices and create a boom is the biggest challenge. I don't think we require any cutting edge reform. We clearly require GST to be implemented with lesser leakages, and I believe that the government will certainly do that over the next 2 to 3 years. Otherwise, the whole process that has been started with GST and IBC should happen within the 270 days limit. We are seeing now number of transactions where the limit of 270 days is not happening. And I believe other than that, IBC is a great product, and we need to have many IBCs to solve other problems, maybe through pre-packaged bankruptcies and things like that. So I believe that we've got all the reform tools. I believe that implementation of those reform tools is the key, and that has been the success of the Gujarat government under Mr. Modi. So I think if we are able to make use of the reforms and improve growth, I think we'll have a very interesting development at this point of time. Having said, we can't change valuations. We are not in 2009 and 14. Both in 2009 and 14, markets were much cheaper, which is the reason why it's not possible to believe that you can have a mega return at this point of time. But having said that, yesterday's development does improve the potential for return. But today, when a single A debt paper gets you more than 10.5% and 11%, I believe credit has become a great asset class, and it fulfills all my requirements of investments being very good, which is people are worried about the asset class, valuations are attractive, and there are very little flows. I think that is met actually by credit and not by equity, because equity is not cheap, and there have been continuous big inflows either from locals or foreigners over the last 3 years, and that's why I would say debt and credit are much more interesting asset classes at this point of time. Having said that, the outlook for equity has improved because the potential for growth over the next 5 years is certainly improved with this election result.
Right. Naren, good morning to you. Now, since you're talking about growth, obviously it's going to be a long drawn process, and in the short term it actually may come at a cost. We've seen budgetary constraints in terms of the overall spending and capex spending that the government can undertake. We've seen that they have made tall promises in their manifesto ahead of the polls and the elections. They've spoken about lowering taxes, interest-free agricultural loans, and many to that extent. Do you think that growth will come at a cost?
See, I think growth comes more than growth. I think what happens is whenever there is a problem, take for example, the problems arising out of lot of bad debts in the banking system. These problems, whenever a problem happens in India, it's not very easy to solve them because there are a lot of people who are hurt in the process. And that, I think, is the challenge. I don't think growth comes at a cost. There are problems at this point of time in the economy. And at all points of time in the economy, you'll have some problems. And when you go to solve problems, there'll be some wounds which will get opened. So I believe that is the challenge at this point of time. But I don't think, the scale of anything that is gone wrong is significant at this point of time. It only that it has to be resolved, and I would believe that the best time to resolve the problem is in the first year of the new government, and not the third year or the fourth year, because what happens is, and there is a very good experience that you can see globally. If you look at 2008 financial crisis, it hurt the entire developed markets. The person who opened the wound and tried to solve the problem was United States, and they got the best recovery. Whereas even today, if you look at Europe, the wounds have not been opened, and that's for the reason we have had a situation that we have had slower growth in Europe, and the problems have never come out. So I think it's important that we work to resolving the problems in the next 1 year. And I believe if that happens, I think we'll have a very, very good period from 2020 to 2024. And growth is a virtuous cycle. Once growth comes, it leads to incomes, income leads to consumption, consumption leads to investment, and that's how we see it. There are challenges. I believe that in agriculture, if you increase production, income comes down. So I think those kind of challenges exist, but I think as productivity improves and we can use the China-US trade war to good effect by emerging as a very, very solid manufacturing base, and if such benefits can be used, I think it will be a great benefit to this country.
In a sense, you spoke about opening of the wounds. For the NBFC space, now that the worms are out of the can and you've got the banks already taking front-loading provisions, do you think there's now a solid foundation for growth and an overall financial growth that you can envisage over the next few years?
Yes, I think the scale of the problem is not as large as that worries me, but I think it's important that you get the financial system moving and people don't stop worrying. I think today people are too worried about debt exposures, which are even good. And in my opinion, that's not a healthy development. And I do believe that there are some problems. At the heart of the problem is extremely costly real estate, which has been leveraged on in some parts of India. And we need to create that mechanism to deleverage it. The best way to do it is somehow to bring prices down so that demand, the nascent demand which exists, gets fulfilled. But bringing prices down has its own costs. I think that's the main challenge at this point of time. And government has to do something in this area. I wish I had easy solutions, and many of the problems that when it comes, it's very easy for armchair people like me to suggest easy solutions. But the reality is many of these solutions are more complicated than that. Having said that, I don't think there is a base growth of the Indian economy. We are looking for that base plus growth of the Indian economy. For that base plus growth of the Indian economy, it's important that land and capital are lower. You can't have, credit rates going up so much. While it's very good for credit investors, you can't have a situation where most of the SMEs are going to borrow at much higher rates, and that's not good for the economy. But these problems are not large. As I said, base growth is still comfortable. And obviously, we should have a good monsoon, and you should have crude prices not spiking up. Like a day like yesterday, along with the great news on the election, you had a 5% fall in crude, which I think is a very good development from an Indian economy point of view. So I think we have to look at overall factors. I think things are fine. It is just that equity valuations are not cheap, except in the PSU area. And in the PSU area, there's a lot of work for government to create an environment where people think that PSUs can deliver shareholder returns. Otherwise, it's going to hurt the government itself, because the residual value of all their investments in PSUs go down. And in the last 5 years, PSUs haven't delivered returns, and there has to be a lot of thinking on the part of government to see what can be done to actually deliver shareholder value even for PSUs, because that improves their residual value and solves their fiscal deficit problem. I think interesting work has to be done in that area as well, maybe through strategic disinvestment of PSUs, large buybacks in the companies which have a lot of cash and low leverage, and various other things. I believe those kind of steps also have to be taken.
Well, that's been a common denominator across voices that we've heard: strategic privatization. Naren, the other question is, so while strategic disinvestment or strategic privatization is one factor, what is from a market's perspective, what is the most important step that needs to be taken? You started off saying that you believe that the scale of the NBFC problem is not very large, yet almost everyone else seems to suggest that amongst the first things that can be done is injecting some much needed liquidity so the system gets some mobility. Would you reckon that is the need of the hour and would be done, and if not done, would disappoint you?
I think liquidity is required. See, the problem is that, if you look at the infrastructure companies or steel companies which went bad, in India we have this tendency to actually slow the resolution of the problem. And I believe that, there are losses in the system. Those losses are not going to go away. If you don't find a quick way of resolving the losses in the system, actually growth becomes slower and affects employment. So I believe that somewhere, what IBC was trying to do and has been trying to do over 270 days is a quick resolution of the problem. We need to create mechanisms where the problems will get resolved quickly, and problems will keep coming. And I don't have clear answers on how these problems can be resolved quickly. But liquidity will certainly, giving liquidity will help. But if you give liquidity, or if you give money to a company which is, let's say, in bad shape, give another 10,000 crores to a company in bad shape, I don't think that solves the problem. I think if there is a loss in a company and if you give another 10,000 crores, the problem only becomes bigger. And that's the interesting challenge that the government and everyone has. Because just by giving more liquidity to an entity in trouble, which is insolvent, I don't think solves the problem. So you should give liquidity to areas where there is no solvency problem, there could be, and there is a requirement. But everywhere it is not just a liquidity problem, it's a solvency problem. So how do you solve the solvency problem? How do you ensure that the solvency problem gets resolved without too much of losses to too many people? And how can you minimize the losses of the solvency problem? But I believe that in India, because nominal interest rates are 10%, any delay in solving a solvency problem makes the problem bigger. And that is the way I have looked at it. And I don't know how the government stroke regulators will look at this area. But any quick resolution by not just liquidity, but also resolving the insolvencies, I think that is the fastest way. If you look at over the last 50 years, the country with the most efficient bankruptcy models was US through Chapter 11, and they have been a big beneficiary of high growth, because problems will come, but those problems gets resolved and people move on. In fact, the other model in US where you get people to pay big fines and move on has also worked for them. Otherwise, people make mistakes and the resolutions to those mistakes never happen, whereas this is a way that US has had, and it has been successful. Having said that, I myself don't have all the solutions. I do agree there is a problem there, but at the heart is overvalued real estate in parts of India.
Okay. Naren, so let's assume that we don't know which is the right way to solve the problem. Let's try and solve the valuation problem and the investing problem. At these valuations, with the monies that you will receive over the course of the next few months, presuming that the DI flow stays strong, how do you solve that problem? Where do you invest?
So there is no problem. I think debt is a great asset class.
Yeah, but equities,
SIPs is a wonderful investment tool for the next 3 years. And in equities, we have been primarily recommending products which are what they call dynamic asset allocation categories, like balanced advantage, asset allocation, etc. And that, I think, is the best way to invest at this point of time. And because there are no outside PSUs, I can't see any deep pockets of very cheap valuations where you can get mega returns from here at this point of time. And at the same time, given the growth impulse, the outlook for India over the next 5 years, everything else is a positive except valuations. And that's why you are in this mixed camp, and you have to get money in mixed products, which are like dynamic asset allocation products at this point of time for investors. That's how we look at it. And I think those products have huge value for investors because they protect their downsides better. And I would believe very strongly in those kind of categories like balanced advantage or asset allocation kind of categories, which I believe would be the best ways to invest at this point of time. Having said that, there are MSCIs selling in May, August and November. If that gives you a pocket where markets become cheaper, and you can invest at that point of time and the market becomes cheaper, then at that point of time you can invest in a wide range of sectors. Today no longer I would say small and mid cap very overvalued. It is just that there can still be a period where the small and mid caps don't perform that well, but the valuation problem is much smaller than where we were 18 months back. So I believe across the market with correction, markets would be very reasonably valued, but the best way to invest at this point of time is debt, investment through models like a systematic investment plan, and investment in products like categories like balanced advantage, asset allocation, equity savings, etc.
Naren, do you feel that markets currently are very quick to punish? The threshold for tolerance of non-compliant companies has been breached. And irrespective of valuations, because when we keep talking about valuations, there are companies which are highly valued but yet attract investments because they're successful companies, they do business the right way. While companies which have been marred by issues, even though very cheap on valuations, are not attracting any sort of investments. So more than valuations, or probably moving in tandem with valuations, is probably the success story of a company versus the failure of a company that the market is looking at.
I think it's a very interesting point. I do agree that quality companies with good corporate governance are less punished by the markets these days. And it's very good for from an investor point of view, that companies with poorer corporate governance do get punished very easily. And I think it's the right thing from a market point of view. But I would say that I hope all the companies which have potential to improve governance do realize this and try to improve. Because if I look at my experiences in 90s with my experiences now, the number of companies which have improved their governance mechanisms and the way they conduct themselves has been so good that the addressable market of good quality companies have certainly become much wider. So I believe it's a very, very good development, and I would request corporates to think about how they conduct themselves, because there is a huge valuation increase which is possible for a company which conducts itself well. The point that you mentioned is very true, because I've seen some of the quality consumer names and other companies, when they don't deliver, those shares hardly fall. And that is a function of this development. And I'm also thinking that many of the residual companies which had poorer governance, they're all going to work on improving their governance. I think this whole concept of financialization and these kind of things, ESG factors, all these kind of things is going to lead to this improvement, and it will be a very, very healthy development for the market.
The other trend that's suddenly emerging is the lag that the broader markets have been trading with compared to the Nifty 50. Now, obviously, the larger, stronger names will continue to deliver, but is it the time for the broader markets to play catch up? And you have good names within the broader market space as well. It's just that, the sentiment was across the board negative. Every company was painted with the same brush. But do you think that now you'll have some of these companies emerge victorious after this entire thing passes out?
Certainly, I think if I look at valuations 18 months back, it was small cap was costliest, followed by mid cap, followed by large cap, followed by mega cap. Now it's inverted. Mega cap is costliest, followed by large cap, followed by mid cap, followed by small cap. And I do believe that over the next 10 years or 15 years, many of the small caps can grow much more than the mega caps. So I think from that point of view, I would believe that it is the broader market which is more investment worthy. From a company point of view, we were used to always communicate about the overvaluation of small cap and mid cap. Now, particularly on systematic investment plans, we've been actually recommending small cap and mid caps much more over all other categories for the reasons that you mentioned. Having said that, I think there was so much of money which went into small and mid caps in 2017-18 that it may take a year or two for the entire excess money which got there to come out. So which is the reason why I think an SIP investor or a very long-term investor is going to be the gainer in this small cap, mid cap situation of today, and not the person who wants to invest for 3 months and 6 months in small and mid cap. I think the 3 month, 6 month view is not clear to me on small and mid cap, but 3 to 5 year and 10 year view is very clear on small cap and mid cap.
Yes, Naren, thank you so much for taking the time out and speaking to us today at Bloomberg Quint. And
Thank you.
look forward to have you more often on this forum. And viewers, thanks for tuning into this very special broadcast.